you can fire and then aim after. And that's what you're gonna do because there's no risk to doing that. On any given deal, one of these models may stand out as the best for me. But I want to share with my investors that which is also best for them. And so when I run a deal, I do as Ian said, and I run it all cash. I'm gonna buy it all cash. What's it look like? Once I've done that, we've created $1 million in equity over 3 years, right? Okay, now that I know how much profit's there between cash flow and equity, I can start to figure out, all right, what would it look like with debt? If I did this all debt, how much would I pay the investor? How much would be left for me? Does that work? And at what interest rate? Okay, cool. What if I did it all equity? What if I did a 50-50 deal or a 60-40 deal? Does that work? Does it work for me? Does it work for them? There are literally, as you move the variables, any deal, I shouldn't say any deal, most deals, I can manipulate these variables so that I would be okay with either a debt deal, an equity deal, or a hybrid deal. And I'm gonna cater it to the investor's objectives. Well, listen, Jay, I love that you want to put some money to work, dude, and I'm happy to have that conversation. Tell me about your goals. What are you trying to do? Are you a lender? Are you looking for a fixed return? Or do you want to play in some of the upside and maybe get some higher returns but endure a little bit of the risk? Based on what Jay says to me, then I'm going to steer our conversation toward equity. That's where we're going to have some fun. And if he's all equity, cool. This is what it would look like. If he says, well, that's probably not where I need to be, there's too much risk, I'd steer back and go, all right, well, we could take away some of the risk by adding a preferred return in, and then we'll just pinch you on the equity a little bit, and that'll result in this, right? So we're gonna give you guys a quick opportunity. I'm gonna give you about 15 minutes. You get in groups, you can go back to the tables, we'll move around a little bit, get the energy up. You're gonna spend 15 minutes working through the challenge on this slide. All you're gonna do is work together, work through the creative tension to create a win-win deal structure where you as a group raise 100% of the money to do this $1.4 million deal. Okay, it's a $1.4 million project, all in. That's all the money you need. And at the end, it's gonna be worth $2.2 million. I did all this math for you. There's gonna be $300K in total cash flow. So the total profits are $1.1 million over 3 years. So you're gonna use those variables to calculate your favorite deal, or maybe all three, whether it's debt, equity, or a hybrid. Debt, this is just an example to close the loop, right? And then this way you'll have this information in the video replay when you guys get that. But we've got 12% interest paid in full at the end. To your point, $168,000 per year in interest, we're gonna be negative cash flow, right? This interest is, as I mentioned before, paid regardless of performance. And to me, this is, I agree with Sean, it's too much risk on the sponsor and it's a lot of negative cash flow. So I'm not interested in doing that either. From an equity standpoint, 50-50 split. I also agree with your guys' math, 13% return. Likely not enough to get the investor excited. It might be, who knows? Hybrid, I did a 7% preferred return. That equals 98K. And so there's really no cash flow left, which is fine. And I gave him 25% equity. To me, and correct me on my math, because this is a little different than what you said. And the math isn't really important in this instance. Again, this is all a conceptual model. But when I did this math at a 7% preferred return and 25% equity, it was late last night when I did this, it came in at a 12% return with the hybrid structure. Would somebody accept that? Maybe, right? It's in the bucket. It's at the low end, but it's a place to have the conversation, and it might leave enough for me to figure out it, to do the deal and be satisfied with the profits. It's all about creating the win-win. So as you guys saw, this deal didn't lend itself to all three. Now, there were parameters. We could give somebody a 4% interest rate and the deal might work for us, right? So it is true that any of these structures will work on any deal. It's just a matter of whether or not it creates a win-win. And so going through all three, this is an exercise I took Brent through way back in the day. He's like, well, I don't know how to decide how much to give him and this, that, and the other thing. And it was like, neither do I. And I won't until you take out one spreadsheet, do the math as if it was debt. and figure out what you can do. Then take out a second spreadsheet. It's like, well, that's a lot of work. I'm like, as you do that, now it's a lot of work, yes. You have to do a debt, an equity, 3 different versions of a hybrid, because it could be 5% and 5% preferred return and 40% equity and all these various things. In time and practice, these things will start to come to you almost intuitively, where you don't really need to do the math. You're like, oh, this deal feels like either an equity or a hybrid, or this deal feels like a debt deal, and you'll drive toward it. And then you'll just, some of you may have experienced this, it's just trial and error. It's guessing, like, what preferred return should we start at? Well, 5, 7, 9. You're just gonna guess, and if that gives you too much of a return to the investor, you just water it down a little, and vice versa, right? So trial and error. This is one of those times, because all you're doing is putting pencil to paper, you can fire and then aim after, right? And that's what you're gonna do, because there's no risk to doing that.